Hello, I hope that we're doing fine. Today we're looking at financial performance evaluation, looking particularly at ratio analysis, and would try to understand, try to be able to identify the various categories of ratios that we have and the purpose of these ratios, how we can use those for analysis. We'd also try to calculate, some of these ratios and then look at their various limitations. In this particular recording, we'll be focusing on the liquidity ratios. We'll start by identifying key terms that we need to get familiar with as we go on. And the first term is liquidity. Liquidity is, it refers to the ease, how easy it is for an asset to be easily converted to cash. How quickly can an asset be converted to cash? That's what we mean by liquidity. And then the other bit that we need to also get used to is the word inventory. These are goods that, the company holds with the intention to resell. So it's the goods that the business wants to resell. Inventory can take a lot of form. It can be, a raw material. So it could be the raw material that hasn't been, reproduced or converted to anything. It could also be in form of work in progress. So it is partly, it's no longer raw materials, but it's not finished goods. And it could also take the form of finished goods. So inventory could be raw materials, work in progress, or finished goods. And then depending on the type of business it is, you would have more or less of the other. So for example, if it were to be a manufacturing business, you would have, a lot of all of this type of inventory. You would have, because you're a manufacturing company, you more likely have raw materials. You would have the ones that have step processing. So they are partly finished, but they are not finished, you're not there yet. And then you would have the finished element of it as well, the finished goods. You find that for manufacturing firms, they would usually have more of, they'll have higher account receivables where, customers haven't fully paid, or the payment has been deferred to sometimes in the future. But for non-manufacturing businesses, they will have, because they are not into manufacturing, you're not producing anything per se, you would not have raw materials, you would not have work in progress. Most of what you would have would be, you would have only finished goods, and you'd have less of account receivables, because especially if you're receiving, payments immediately from your customers. Okay, which ratios? Reasons why, there are lots of reasons why we prepare ratios. If you've looked at the video on introduction to accounting, when we're looking at stakeholders, if you haven't watched that video, I would advise you to please go listen to that video where we had discussed stakeholders and those who are interested in accounting information. So the reason we do, we calculate ratios or prepare ratios is so that you can do some form of comparison. So you're either going to be able to compare previous years, so as a business, for example, how have you done over the last 5 years? How's your performance been in maybe last year and this year, or maybe even across the industry? How are you doing? How are you faring with your competitor? And then, a lot of the ratios we also calculate in businesses helps not just users, external users of the information, but internal users, so that we're able to make business plans. We're able to, when we interpret the results we see, we know what steps to take next and all of that. In that video we discussed, so the video I referred us to is, Introduction to Accounting, where we discussed users of accounting information. So we mentioned the number of stakeholders who are interested in accounting information, and we classified them into internal stakeholders and external stakeholders. So you find that, people who are interested in these ratios would, will fit into this stakeholder classification. So let's pick, for example, we'll pick managers. Managers want to know, how efficiently are we running this business? How efficient is this department or that department? Or how are we doing compared to last year's performance? How are we doing compared to other businesses within this industry? Those type of information is what, managers will be interested in, and that's why we need to prepare ratios. Other users, external users, for example, the bank wants to know, how is this business faring? Are they creditworthy? If we extend credit facilities to them, would they be able to repay back? In what period would they be able to repay? How's their cash flow? What type of loans do they need? All of those we'll be able to get when we prepare ratios and interpret those alongside our business. I want you to pause and think about the other stakeholders, what would they be needing ratios for? Why would they be interested in these different ratios that we're about discussing? I want us to pause. You can pause the video and reflect on it. So think about potential investors, for example. What would they be assessing in the company to help them make an informed decision as to whether to invest in the business or not to invest in the business? Look at existing shareholders, for example. Do they need to decide to remain in the business, or should they just sell their shares if they think that the business isn't performing well? Those are type of thoughts I want us to think about. So these various users, what do you think they'll be? Why do you think they'll be interested in issues? Okay, so today we're going to be focusing on just one of the ratios, but we have a lot of ratios that we can use that businesses use to assess how their performance, their financial performance. We can classify them into three. The first one is the liquidity ratio, which is the focus of this video. They tell us how quickly a business can turn our assets, our current assets, into cash. Into cash. How quickly can you convert what you have as current assets into cash, so that if we have debts to pay, we know that we can quickly. If our creditors ask us they want their money paid now, how quickly can we convert what we have as current assets into cash to settle those debts? We are going to be looking at two liquidity ratios, and that's current ratios and asset test ratios. The other ones is profitability ratio. You want to see how much profit is your business making. And in looking at profitability ratios, we have gross profit margin, net profit margin, the gross profit markup, and the return on capital employed. But we're not focusing on that in this video. And then the third one is how efficiently are we using our resources. So you want to, we're going to be looking in that ratio. We're going to be looking at inventory turnover period, receivable turnover period, and payable turnover period. But in this video, we're focusing on the liquidity ratio. So we'll be discussing both current ratio as well as asset test ratios. Okay, current ratio. So what current ratio shows is that it shows us, do we have sufficient liquid assets? Don't forget when we were discussing liquidity, we said how easy, the ease of converting our assets, our current assets to cash. So how sufficient is our liquid assets that we can convert into cash, so that if we have such short-term obligations to meet, we're able to meet them when they are due. It also shows us, okay, before I go there, the importance of we knowing how easy it is for us to quickly, convert our liquid assets, our current assets to cash is that, imagine our creditors come to us for payment and we're unable to make payments. They can effectively, close down our business. So failure for us, failure for the business to meet the payments means that, the business could be shut down. The business could be shut down. Current ratio also helps us to compare our current assets, which will become liquid in 12 months, with current liabilities, which will become, repayable in 12 months. So we want to look at how much assets do we have that can be converted quickly into cash, in comparison to how much short-term obligations we have. So that's what we're doing with, current ratio. Now, the question we'll be thinking about is actually, what are our current assets? What are our current liabilities? Because we said to calculate current ratio, what we need to do is divide our current assets by current liabilities. So I want us to think, what is current assets? What is current liability? So I want you to pause. So look at the examples I have presented here. What is a current asset? Cash is a current asset. Now, inventory, initially I had explained to us what inventory is. The goods we have, with the intention to resell. And I said that, we have the inventory could take the form of raw materials, work in progress, or finished goods. So inventory is a current asset as well. And then here we have our account receivables. So account receivables, so those customers of ours that we have sold, goods to, or we have offered services and they are yet to pay us, we have deferred payment to sometime in the future. So this account receivable, they are current asset because repayment will be done within a year. It would not exceed a year. So that's also a current asset. So what are current liabilities? I think that becomes obvious now. Account payables is a current liability. So this is, we've been supplied by our suppliers. We've got goods and services from our suppliers, but we haven't paid them. We have deferred payment to a period in the future, which is not more than a year. So that's account receivables. And we have our overdraft here. So when we take loans, short-term loans from the bank, that is more than a year, that's an overdraft, and that's a current liability. So with current ratio, we said, current ratio is current assets all over current liability. So all of these current assets that we have here, the current assets that we have, so this current assets that we have, we're going to be dividing it by, so we'll put this here. So this, when we add all of this together, we divide it by our current liability. That's simply what current ratio is. So let's see that in action. So here we have cash is 10,000. We've been told our inventory is 30,000. We've been told our account receivable is 60,000. So all of these would be our current assets. So we have all of these current assets. And then now we also have our current liabilities. So here we have current liabilities. We have current liabilities for these two, 45,000 and 5,000. And the question is, what is our current ratio? What is our current ratio? What we want to do is you want to add your 10,000, right? You want to add it with 30,000, that gives us 40,000, and you want to add it with 60,000, and that gives you 100,000. So we do that addition. We have current assets is 100,000. We add up also the current liability, which is 45,000 plus 5,000, that gives us 50,000. Our current ratio, therefore, is 100,000 divided by 50,000, and that should be equals to 2. So we have 2:1. What this means is that, for every £1 that the business owes, we have £2 of assets that can be easily sold to pay the £1. So for every £1 of assets that, for every £1 that we owe to our creditors, we have, a £2 of asset that we can quickly convert to cash to pay to make that settlement. Let's look at another example. So here we've been told to calculate the current ratio for 2009 and 2010. So the extract of the balance sheet says that the current assets is 11,298,929. As at 2009, and as at 2010, it has increased to 13,073,604, of which stock, which is our inventory, is this amount. So stock, which is our inventory, is this amount. And then we have our current liability. For calculating current ratios, we're not really interested in stock for now because, we've been given the current asset already, which means that, stock is inclusive of the current asset. Don't forget that we had already mentioned what our current assets would be examples of. So we'll have inventory, we'll have our cash, whether it's cash at hand, cash in bank, we'll have our account receivables. So what we just need to do is, pick up this figure. For 2009, we'll pick up the current asset figure, right? So we'll pick up this current asset figure and we'll divide it by the current liability figure. And for 2010, all we need to do is pick up 2010 current liability and divide it by, current asset and divide it by current liability. And what does that tell us? We would have current asset this, current liability this, we'll have 1.07:1. So for every £1 that we owe, we have £1.07 worth of assets that we can use to quickly repay it. And in 2010, we have a higher ratio, £1.22. For every £1 of assets that we owe to our creditors, we have £1.22 to be able to 1.22p to be able to repay back of assets that we can quickly convert to cash to repay back. So now let's do a quick practice. Do you want to pause the video and calculate this current ratio for 2015 and 2014? For the 2 years, do you want to quickly pause the video and do that calculation? You'll find that in this question, you've been given current assets, and we've been told what current assets consist of here. It consists of the inventory, it consists of trade and other receivables, and we have here cash and cash equivalents. And current liabilities, we've been told trade payables, the borrowings, so short-term borrowings, current tax liabilities, provisions for liabilities. And we've been told that that is, 82,970 for 2015 and 69,702 for 2014. So quickly calculate the current liability, current ratios. Current ratios is equals to current assets divided by current liability. So what do you have? What do we have? You can pause the video and do that. Okay, so if you do that, what you'll find is that all you need to do for 2015 would be for you to pick your, so all you need to do is pick up the current asset figure, which is 86,234, and divide it by 82,970. And what you have is 1.04 ratio 1. For every £1 that we owe, that our business owes our creditors, we have £1.04 of assets that we can quickly convert to pay that off. And for 2014, we have current assets. We pick that current assets, and we'll pick this current liability and divide, and we'll have 1.0411. So you see that the current ratio for both years appears to be the same thing. Okay, great. And I hope that you were able to do this calculation. So that's for current ratio. So current ratio is your current asset over your current liability. How quickly can your current asset quickly settle your current liabilities? How quickly can you do that so that you know how safe your business is? The next one we want to discuss is the asset test ratio or the quick ratio. And the reason we're doing that is that you see that of all of the current assets that we have mentioned, we mentioned inventory, account receivables, cash in hand, cash equivalents, and all of that. The one that is more difficult to convert to cash, to easily convert to cash, would be our stock, will be our inventory. So the question is, what might stop a business from selling its inventory? What might prevent us from quickly, converting our inventory to cash? Sometimes what we'll find out that is that business might not be able to quickly sell their stock so that they can pay up their, liabilities, their current liabilities that are due now. And a lot of reasons could be, there could be a number of reasons for that. There could be a number of reasons why they are not quickly able to sell off those stock. And so therefore, what we try to do is to exclude, we try to see with quick ratio or asset test ratio, we want to exclude that element that is harder to convert to cash and see how safe we still are with being able to meet our liabilities, to be able to still pay up our liabilities, right? So we'll take, so what the asset test does is that, it looks at business liquidity position after we have taken away the most difficult element to turn to cash, which is inventory. So asset test ratio, or we call it quick ratio, is current assets, take out the element that is harder to convert to cash, inventory over the current liability. So whilst current ratio is current assets straight away over current liability, asset test is current assets, you take away the inventory element and divide it by current liability. So let's see what that would look like. So what we just simply mean is, whilst in current assets, current ratio, what we'd have done is we'd have added the the cash element, would have added the cash elements, would have also added the inventory element and account receivable and divided by, the current liability. In this case, we'd have our payables, account payables, and our bank overdrafts straight away for current ratio. But in asset test ratio, we need to take away this element. We'll take away the inventory element. So you have your current assets, deduct any element that is inventory, and then divide it by current liability. So let's see that in an example. So we have, in that case, if we look at, so we'll go back to this figure. We had cash was 10,000. Currently, cash was 10,000, inventory was 30,000, and we had accounts receivables was 60,000. We had taken away inventory, which was 30,000. So what we have is cash of 10,000 and inventory, cash of 10,000 and account receivable of 60,000. If you add that together, you have 70, and then all over your current liability, which was 50,000. Now, if you divide both of them, you'll see that we have 1.4 ratio 1. So for every £1 that we owe, our suppliers, for example, we have £1 and 40p, of assets that we can quickly use to settle that. And this is, we're not considering the inventory elements of it. So for, so we have ratio of what? 1.4 ratio 1, meaning that for every pound our business owes our suppliers, for example, we have 1.4 of assets that we can quickly, sell to repay it. Okay, now let's try this. Do you want to pause the video and try this? You're looking to calculate the asset test or quick ratio. We've been given for 2 years the current assets. This was the same question we attempted the first time. So here's the current asset, here's the current liability, current asset, current liability for 2010 as well, and you have the stock element. So pause the video now and calculate the asset test ratio. Your asset test ratio formula is your current assets less your stock or your inventory all over current liability. So you will have this you subtract this amount from it. Don't forget you're going to subtract this amount and then all over your current liability. In this case, you have this, subtract this amount from it all over your current liability. And this is what we should have. If you subtract 1,459,394 from 11 million, you would have what you'll be using for your current assets, right? You'll be having what you use as the current assets to divide, and then you divide that by your current liability, and you should have 0 points. Oh, sorry. You should have that answer, 0 points. My slide couldn't go back, but it's all right. And then you do the same for the other year as well, 2010. Okay, for this particular question, do you want to give it a try as well? Same question that we used to calculate our current ratio, but this time around, you need to take away inventory. You need to take away inventory. So you have 86,234, take away inventory amount. In this case as well, you have 72,704, take away the inventory amount for 2014. Whatever you have, you divide it by your current liability, and we should get our quick ratio. Do you want to give that a try? Okay, if you have tried that, this is what you should have there. Your 86,000 minus 42,000, you divide it by what you have here. And same thing for 2014. And when you do that, you have 0.52 ratio 1, 0.55 ratio 1. I hope this is clear. I hope this is clear. So we'll end with that for now. In the next video, we'll be talking about the profitability ratios. We'll end with this for now. I'll see you in the next video.